Well, with me now is Cairn Capital's Graham Neilson. He's Chief Investment Strategist. He helps oversee some $25 billion worth of investments. So, well, he's a good person to be talking to right now. And so, Graham, how would you describe sentiment? Because we started the week with this sense of optimism, didn't we?
Yeah.
That we would see something comprehensive in a week's time from European leaders. The Germans pretty much put a bullet through that just yesterday. So how disappointing is this to the markets?
Well, I think we kind of have to look at what the market's been doing over the last week or so in the context of where we were at the beginning of October. At the beginning of October, there was an awful lot of fear around. Markets were pretty oversold. Valuations looked fairly stretched. But at the same time, we also had some building belief, or that fabled word hope, that maybe there was a solution due towards the end of this month. And I think basically what we've seen is a hope rally starting to unravel over the last 2 days.
So what does that mean if that is starting to, I mean, how is this going to impact appetite for risk going forward?
Well, I think appetite for risk is still very low. If you look at the rally that's happened over the last week or so, I would say it was fairly low degree of participation. And actually, I think that investors are now in a wait-and-see mode. I don't think there's been a big allocation swing at the beginning of October. And I think a wait-and-see mode generally is probably the right thing to do. But there are definitely areas of the market that are more stressed than others. And that's the areas that we're looking at.
Given the serious risks that we're seeing, that we're up against right now, it seems sovereign debt and bank recapitalization are front and center for investors right now. And I know that you're saying, well, it's just better to wait and see what happens rather than taking any bold moves in terms of asset allocation. But there must be people out there thinking, I've got to do something in case this really gets bad. So what are you doing to hedge those risks?
Well, there are certainly the rally of the last 2 weeks or so has given us an opportunity to buy some fairly cheap downside protection. I think on the other side of that, what we're looking at is what is a potential recapitalization and maybe a more active European Central Bank and some degree of movement with regards to a more realistic haircut for Greece. What does that mean for parts of the credit market? Because ultimately, this is about having a global situation with too much debt and not enough growth. When there are stress points in the market, there are going to be opportunities. And I think that we're looking at the top part of the capital structure in banks and a little bit further down, but not into equity. We're not an equity manager. But if this is about some form of recapitalization, and it is going to be done on a more selective level, then what the market is going to be looking at is banks that have a bigger capital cushion. And that is very good for the top part of the capital structure, but not necessarily for equities. Because I've never heard a bank say, we haven't got enough capital. You will always hear them say, we've got enough capital no matter what the circumstances are. But they will continue to come to the market because they're going to need more capital. But that's good for credit investors.
So then what is the most important consideration in your mind when you think about your investment strategy?
Risk reward, simple as that. There are so many investors and a big pools of capital in Europe in particular that invest in fixed income assets for yield. We tend to think of things in a different way. Am I getting the right amount of return for the risk I am taking? And is that risk going to decline over time? And I think for certain parts of the bank capital structure, subordinated as well as senior, that risk will decline over time.
Is part of the problem with the macro outlook and the shadow that it's casting over the markets in general and many companies? I spoke to one analyst from Credit Suisse earlier on saying, listen, there are some great investment opportunities out there, and if you look at the company fundamentals, there are opportunities, but people aren't doing that because the risk is so great. So I'm just wondering how much the macro situation right now is clouding the way you perceive risk.
Sure. I think that's very much the case. If we think back to maybe 2 quarters ago, people's views were not clouded at all. There was an assumption that growth was okay, that the sovereign situation was more or less isolated in Europe, and therefore the allocation decisions were, we want to be long equities, we want to be long commodities, and we probably want to be long high yield. Now we're looking at the market that's completely flipped on its head and is very underinvested. So even though there's a lot of these risks around, there may well be some short-term solutions or better than expected news flow from areas like perhaps the US and the growth front. Maybe even China. Maybe the perception of China is being slightly overdone to the downside as well. So there are areas around the globe that are going to be where there's maybe too much fear priced into the market, and that's where the opportunities are.
So fast forward a few months from now, the end of the year, could we see an upswing? And if so, what would the catalyst be?
Sure. Well, I think that the beginning of October, there were a number of catalysts that were falling into place. I think basically we need to get this meeting on the 23rd out the way. We need to get probably the disappointment of that out the way. And we need to get the noises that are going to come out inevitably from the G20 about a more concerted global effort to contain the damaging implications of European debt. Once we get through that, I think the market's going to be more able to not trade on hope, but trade on more of a fundamental outlook. Yes, it's bad in Europe and it's going to stay recessionary as an environment, but I think an underinvested market can actually have a bit more momentum into the end of the year.
All right, yeah, just needs to be perhaps more recognition of that, in your view. Thanks very much indeed. Cairn Capital's Chief Investment Strategist,
Thank you.
Graham Neilson.